Well, good afternoon and welcome to this week's webinar presented by Beresford Booth. I'm Per Oscarsson. I'm a member of the Business and Real Estate Group here at the firm. And with me today on today's webinar is Caleb Tingstad, also a member of our Business and Real Estate Group. And our topic today is assignment of fractional interests in an LLC or a limited liability company. I think we're both going to try to use LLC rather than limited liability company when we talk about it, just because it makes it a little bit easier. So first of all, assignment of an interest, of a fractional interest in an LLC is not all that different from an assignment of, or a gift, particularly if it's done as a gift, from any other kind of gift. There are a few technical matters that are required, but generally the considerations that go into that are very similar. Now, first of all, what's the purpose of the assignment? Is it for potential estate tax purposes, trying to reduce the size of your estate in order to save estate taxes upon your death? Or maybe it's just a transfer of ownership management functions that may or may not be tied to estate tax reasons. When you actually consider those, let's talk about the estate tax impact, and that is, you have an annual gift exclusion, federal gift exclusion of $16,000. So every individual can give up to $16,000 of value of property, whether it be money or other types of property, personal property, such as an interest in an LLC, or real property, real estate. And they can give that to as many people as they would like without having a federal gift tax implication. Husband and wife could each give up to $16,000 a year, and that's every year. Now, if you go over the $16,000 to any person in a given year, you have a federal gift tax return obligation. That is, a gift tax return has to be filed with the IRS in the year following the gift to indicate how much of your gift was taxable, because you do have a lifetime gift tax exemption or exclusion. But that, of course, reduces as you use it during your life. The amount that you have left to use decreases. And it can also impact the estate tax exemption that's available at the end of your life, because that's a unified credit. And so the gift tax credit or exclusion and the estate tax exclusion have to work together. So it can be very important to determine what is the value of your gift, because you may have to file the gift tax return, but until you've gotten to the federal limit, which this year is a little over $12 million, once you've gotten to the $12 million limit, you will have gift tax to pay. Prior to that, you only have to report to the IRS the amount that you have used of your gift tax exemption.
So, Per, am I right in understanding that that there is a threshold of value of an estate to where some people should be concerned about yearly gifting, whereas if your estate is perhaps not at the threshold that is perhaps subject to estate tax, either at the state or federal level, then maybe you ought not be as concerned about the annual gifting issue?
True. For an individual, and Caleb makes a great point here, the state of Washington, which is one of only about 11 states with an estate tax, the threshold for being taxed is a taxable estate that is where the total estate exceeds $2.2 million. And assuming there are no other exemptions that are available, if you have an estate over 2.2 million for Washington estate tax purposes, yeah, then as an individual, then the gifting probably makes sense. Remember too that Washington does not have a gift tax. So there's no limit from the Washington perspective as to how much you use for gifting, and it doesn't really affect your Washington estate tax exemption at the end of your life. There's still the 2.2 million, but it is a consideration to be made. And for a married couple, again, as it stands right now, the married couple would have 4.4 million, just a little bit under 4.4 million between them to use for those purposes.
So how do you go about, so if an individual decides that, or if they put together their financial plan and their estate plan, and it looks like they're going to be subject to some estate tax on death, either at the state or either at just the state level or both the state and federal level, how do we go about putting together a plan where they're going to be gifting these fractional interests in LLCs? How do we go about doing that?
Well, one of the things to determine from the outset is, are they willing to make a gift, or are they interested in making a gift that's over the annual exclusion? Because if they've got a significant estate and they may have already used up a good portion of that exemption, or they may need availability of that exemption, the estate tax exemption at the time of their death, you really need to take a close look at what kind of level of assignment or transfer are you going to make. If the value is under 16,000, you're probably not going to be too concerned about it. But it could have a significant impact if you make a gift that exceeds the 16,000 to any individual person, which probably means you've got to have an appraisal done of the total value of the LLC that you're talking about, because now you need to know, if you're giving a gift of an LLC interest, there may be units involved. It may be a percentage, and if you got to apply the percentage to the total value of the LLC, assuming the individual or the married couple owns 100%. Let's just use that assumption for purposes of our discussion today. Assuming you own 100%, you need to determine whether that value is something value that you gift is actually going to be subject to tax, which means you've got to have an appraisal done of the value of the LLC. And once you do that, now you've got to look at, maybe there are some discounts that are available. And so for appraisal, I think it'll be a great idea for someone to have a professional appraiser, whether it be a real estate appraiser, if that's the main value of the LLC. If it's a business, having a business appraiser appraise that. And then you start looking at what kind of discounts might be available, such as a minority discount, because typically if it's a small interest that is being transferred, and I'd say small in a percentage term of the total value, then that minority interest holder, assuming all rights with the interests that are transferred, actually gets transferred. And I'll talk a little bit about that a little bit later. But assuming all the rights that go with the membership interest are to get transferred, then that minority interest holder doesn't have an awful lot of power or authority. If it comes to a membership vote on something, if they've got 2%, they're probably not going to be able to swing too much of a decision the way they want, if it's contrary to the decision of the owner of the majority interest. And how much that discount is going to be from the total value of the gift, that's something that I think employing an accountant to help with determining how much of a discount should we take or can we take, because the higher the discount, and particularly if you add it to other types of discounts, the higher the discount, probably the more scrutiny it receives from the IRS. Did someone take way too much? If they did, then the IRS may come back with, hey, you owe a little bit more tax and maybe some interest and penalty. Another one is the liquidity of the interest. How easy would it be for the recipient of a small percentage to sell that interest? There may be limitations in the LLC agreement on how you transfer. You may only be able to transfer to other members, or maybe people within your own family. You may not be able to sell to a third party, and maybe under the circumstances the recipient faces at sometime down the road, it may be necessary for them to somehow transfer that and get some sort of benefit, probably an economic benefit from doing that. But the LLC agreement may preclude that. Again, how much of a lack of liquidity discount you might be able to get can vary. And again, the greater the discount sought, the more potential for scrutiny by the IRS.
So when you're talking about discounts, and we're trying to decide which discounts to apply. The recommendation is always to go to somebody who's qualified in that area, whether it be a licensed real estate appraiser or a business appraiser or an accountant, to actually determine which discounts apply. And the significance of the discount is that particularly when gifting fractional interests in LLCs, is you actually end up being able to transfer more property than you otherwise would have, because after you apply that, you transfer the value of the property and then discount it. And the beneficial thing for our purposes, which we're talking, one of the reasons why the annual gift exclusion is so significant, is because we always want to try and work with the appraisers and the accountants to get the value that's being transferred below that annual exclusion, so that you can gift more property, but without having to file that annual gift tax return, and at the same time potentially incurring some kind of unintended tax consequence, and at the same time limiting your taxable estate on death, so as to avoid additional Washington estate tax and potentially federal estate tax, depending on the size of the estate.
Yes, and I'd modify what you said just a little bit. I think on the valuation, I definitely rely on the appraiser, whether it be a real estate or a business appraiser. But I think for the discount, I would want to engage an accountant, particularly one who's got experience dealing with the IRS on taking those discounts, because they're going to be able to tell you, or hopefully would be able to tell you, if you take a discount of X, you're probably not going to have any issue with the Internal Revenue Service. They're probably not going to look at it with a great deal of scrutiny. But if you take a discount of Y, and particularly if you take multiple discounts, and I think I've left one out, you get the lack of liquidity and the minority discount. But if you take a couple of those discounts and you kind of stack them on top of each other, that may also invite scrutiny. But I think that's something where the accountant would be able to give you a better idea what is likely to be acceptable and not incur that additional scrutiny. Or even if it does incur additional scrutiny, they may be able to tell you, even though it has been scrutinized a little bit, it's not likely that the IRS will take it any further and do like a full-blown audit and potentially assess additional taxes or interest or penalties. So we'll get to the next part, which is really the mechanics of doing the assignment. And typically, an LLC does not have a certificate that represents the ownership interest or the membership interest in the LLC. Unlike a corporation, corporations may or may not issue stock certificates that indicate how many shares you have. Because the membership interest in LLCs, there's a wide variety. There may be a number of units that are issued or that you're given credit for. There may just be you own 24.5% of the LLC. So the document that would transfer the interest is just a simple assignment document that's drafted that indicates that it's whatever percentage is being given. That's probably the easiest. And then you have to look elsewhere to determine, okay, what's the value of that percentage? Because you're just saying, I'm gifting 2% of the value of this. But the assignment document, the assignment document may not say what's the dollar equivalent of that 2%. Typically, the assignment document does not have to get recorded anywhere. The original would probably go to the recipient of the gift. Hopefully, the transferor, the person giving the gift, is retaining a copy. And hopefully, the LLC in its records also has a copy, so that it can reflect in its own records the change in the relative membership interests of the various members, because that will be important come tax time, because LLCs will typically issue what's known as a K1 that indicates each member's percentage of the income or loss that that they may take on their personal income tax return. So with an assignment of an LLC interest, typically, again, there's nothing recorded anywhere, as opposed to if you owned real estate, for example, and you owned it personally, you do a deed, you've got to file a real estate excise tax affidavit, and the deed gets recorded in the county records, at least in Washington, usually with the county auditor. And the nice thing is that there is an exemption from real estate excise tax when you're making a gift. But that when you're making the gift of the real estate, you have clearly made what has become a matter of public record of transferring some sort of an interest to the recipient.
Yeah, and that's one of the reasons why we really like it. We advise individuals that own real property to transfer the real property into an LLC, because then you can essentially gift interests in the real property by just transferring interests in the LLC and avoiding any public record. It keeps anonymity, and also can help avoid scrutiny, so that when you're applying multiple discounts, when you're gifting fractional interests, it helps maintain a certain degree of confidentiality in what you're doing, for purposes of avoiding scrutiny.
True. Until you get to the point where at least 50% has been transferred, 50% membership interest has been transferred, not necessarily by the same person, but where over a period of 3 years, if a 50% interest has been transferred, that's treated as a controlling interest for real estate excise tax purposes. And there is a Washington regulation in the real estate excise tax area that requires that if there is a controlling interest transfer of any kind of an entity, then a real estate excise tax affidavit still is required, but there's an exemption potentially, and that can work in the gift area, so that if you gifted more than 50% over the 3-year period, and it's kind of a rolling 3-year period, then the gift exemption would still apply. The problem that you run into otherwise is if you're transferring it for consideration, whether that be transferring it for cash, transferring it for other property of any kind, then the valuation is determined by what you're transferring. And so there will still be a real estate excise tax. But again, if it's gifting, then the real estate excise tax exemption for gifts is still available.
Well, Per, do you have anything else to add on this topic? Is there any place else you want to go?
I can't think of anything right now. I think again, these are all individual determinations. It may be in the best interest of someone to make a gift of a fractional interest in an LLC. And as you said, putting the property into an LLC, particularly if it's not your primary residence, is a great way to go, not just for tax purposes, but it provides you a level of protection from personal liability, assuming that you are operating the LLC properly and it's properly capitalized. So it's going to have the property in it, but hopefully it's got some cash in it to take care of things like paying for insurance on the real estate, as an example. That if the LLC is properly capitalized and there's no commingling of the assets of the LLC with the personal assets of the members, and it's not used for purposes of trying to defraud a creditor, then the limited liability shield that's provided by an LLC is a great way to protect people. I think of rental properties as being a very good, probably the best example. Hopefully that rental property, you've got enough insurance on it to cover in case there's a significant casualty to the property, or someone's injured or dies somehow in connection with the property. But the fact that there's maybe insurance isn't enough to provide the protection. And so if you've got the property in an LLC and the LLC maintains the insurance that's sufficient, there's probably a very small chance that someone who might be injured on that property could kind of go through the LLC and get to the members who own those interests, so that their other assets may be subject to satisfying any kind of a judgment that the injured person might have received.
Yeah, and so I think, with that, like Per said, with all of these things, they're very personalized considerations. Where just making a determination as to whether gifting a fractional interest, whether to do that in the first place. There needs to be an understanding as to the extent of a person's estate. Whether it's even subject to Washington or federal estate tax. So it's all very personalized, and there's almost no way to provide any kind of general rule without seeing someone's individual situation. And so to the extent that there's any questions or anything like that, we definitely recommend picking up the phone and giving us a call. We'd be more than happy to sit down with you and walk you through all of this. And because like we said, this is very personal. And there's no one size fits all, but we'd love to sit down and have a conversation with you. Other than that, Perry, you got anything else?
Yeah, one other thing is kind of beyond the scope of this kind of introduction to the issue, and that has to do with the amount of control that goes with the assignment. Some people may want to limit the control that is gifted. Whereas if you gift the membership interest, let's say it's 2%, and you gift everything that goes along with that, in and of itself, yeah, there may not be a great deal of control just because of the size of the amount of the gift. But if beyond that you want to try and limit control, such as so that, for example, it was a membership interest in the transferring party's hands, but now you say, well, my recipient, they're not going to be able to vote that. We're going to restrict their ability to vote until a certain point. Or it restricts something else. Maybe it restricts distributions on that membership interest. That could also subject you to additional scrutiny. And so that has to be really carefully considered. If it's just, what I'm gifting, you're getting the whole, as we think of the whole bundle of sticks. You're getting all the rights that go along with that. If you're going to try to restrict those rights in some way, that really calls for a conversation, because depending upon the nature of the restriction and the extent of the restriction, that may end up having a pretty negative effect on the gift, both from the transferring party's perspective as well as the recipient party's perspective. Yeah.
Well, I don't have any more to add. Per, you got anything else?
Well, I'd like to thank everyone for viewing, and join us next week. Well, it won't be Caleb and me, but our litigation group from the firm will be presenting next week's webinar. Thank you.
Thank you.